Because Leatt Corporation, ticker LEAT, is an OTC microcap stock, there are, no official Wall Street consensus estimates to beat or miss today. But benchmarked against last year, Q2 revenue came in at $16.39 million. That's a meager 1% year-over-year increase.
Right, and basic EPS landed at 15 cents, with net income actually dropping 20% to $909,000.
And they provided no formal Q3 guidance, right?
Yeah, none at all. But they stubbornly reiterated their aggressive full-year 2026 targets of $74.29 million in revenue and 69 cents in EPS.
Wow, that is bold.
Yeah, it is. And in response, the market just threw a fit. I mean, the stock took a high-volume dive, dropping roughly 9.8% to close at 11.90.
So we're pulling from their fresh Q2 report and management's commentary to figure out what's really driving this. The mission for you today is to determine if a 20% drop in net income actually justifies that 10% haircut. Or, are you looking at a market overreaction to a localized logistical hiccup?
Well, looking under the hood at the segment data, you see a business in a serious transition. I mean, body armor grew 6% to $8.75 million.
Okay, that's decent.
And helmets jumped 14% to $3.56 million. But the legacy product, their flagship neck braces, those plummeted 23% to just $542,000.
Man, that just screams market saturation to me. I mean, a rider buys a high-end neck brace once and keeps it for years.
Exactly. They just don't wear out that fast.
Well, helmets and body armor, well, you crash, you replace them. The recurring revenue loop is much tighter there. So, it makes sense why the growth is skewing heavily toward those protective segments.
Yeah, precisely. And, while overall revenue was basically flat, their direct-to-consumer sales surged 68%.
Oh, wow, 68%.
Yeah. By relying less on wholesale distributors and selling directly to riders, they bypassed the middlemen. And that specific pivot pushed their gross margins up 2 full points to 45%.
Right, it's like skipping the dealership to buy straight from the factory. They capture all that intermediary margin.
Exactly.
But wait, that creates a glaring contradiction in this report. If they're selling higher margin direct-to-consumer goods and overall gross margins are expanding, a 20% drop in net income makes absolutely no sense. The bottom line should be protected, shouldn't it?
You'd think so.
Yeah.
But management points the finger entirely at global shipping. They cited container shortages that delayed roughly $653,000 in international distributor sales.
Ah, the classic supply chain excuse.
Right. CEO Sean McDonald insists there was absolutely no revenue lost, claiming those specific shipments cleared in early Q3. He said it supposedly gave them a hot, blazing start to the current quarter.
Yeah, well, I'm not buying that as the full excuse.
No, I thought.
No, I mean, a delayed shipment explains flat top-line revenue, sure, but it completely ignores the expense side of the ledger. The real anchor on their net income was a nearly 16% spike in operating expenses.
Yeah, that is a huge jump.
Exactly. You don't accidentally hike salaries and marketing by almost 16% just because a cargo ship was late. They are aggressively spending way ahead of actual revenue.
Well, management frames that OpEx spike as, necessary groundwork.
Yeah.
Like, they're funding heavy marketing for a new wireless helmet partnership with Carbon Systems.
Okay, that makes sense for their core market.
Right. And they're also integrating a newly acquired Polish company to launch the Gear IT bike care line. They're basically betting that front-loading expenses now will ignite sales in the second half of the year.
Wait, bike care? Like soap?
Yeah, cleaning products, basically.
Wow. Pivoting from life-saving, highly engineered neck braces to selling commoditized bike soap is a massive brand risk.
It really is.
It's like a specialized neurosurgeon deciding to open a car wash on the side. Sure, it diversifies revenue, but does it dilute the premium brand equity they've spent a decade building?
That is the tightrope they are walking right now. But to be fair, they are doing it with a bulletproof balance sheet. I mean, they have $19.53 million in cash and zero debt.
Zero debt is always nice.
Right. But because of this sluggish Q2, they now need an absolute monster of a second half just to hit those FY 2026 targets they just doubled down on.
Which leaves you with this final thought to chew on. We've talked about their shifting product mix and rising marketing costs, but look at that pristine balance sheet and depressed valuation.
Yeah, it's an interesting setup.
With nearly $20 million in cash, zero debt, and a stock price taking a beating, are they successfully transforming into a broad lifestyle brand, or are they quietly losing their core identity? And honestly, does that identity crisis make them a prime acquisition target for a massive power sports conglomerate looking to scoop up a legacy brand on the cheap?
That is the big question to watch.
Make sure to follow the show for your daily deep dive into earnings coverage.